So that sets us up. Let's take a look at how Evan Lucas is digesting all of that's out there. Evan, good morning to you. Let's just begin with the markets in general, because this was not a good performance through the overnight period. Second day in a row that U.S. markets have fallen, and all analysts that I'm reading this morning are just saying, look, people are very cautious out there.
Yeah, they certainly are indeed. And I think what's also happened is there's been almost like by stealth a rally in the bond market, and that is the other part of this sort of equation that you can start to see. And there's almost a sort of a three-part cross. Equities are starting to see pressure, and certainly downward pressure. So yes, the last 2 days, but if you go back over the last 6 to 8 weeks as well, the down days are now starting to outweigh the up days, and that is part of it. Volatility is starting to creep up, and as I said, the bond market is the key one here. They're really starting to creep on, and if you have a look at the yields as well, they're flattening quite dramatically, which means that the market is realistically, that cautiousness you're hearing in analyst comments is actually being translated into market activity. You know, the difference between 2 and 10-year US Treasury bonds has narrowed to its lowest level since March last year, and that was before Bernanke came out and said that QE was going to start wrapping up. So at 215 basis points, it's 1 basis point away from that low we saw in March last year. It means that there's certainly a drive there. And if you have a look at US yields, they're now at the lowest we've seen since May last year, and 10-year Treasury yields are sitting at 2.5%. Not a huge movement in currency, so it means that there is certainly domestic, consumer issues around that, and that's where you're starting to see that really slide away. So it's starting to see that idea that maybe we're just starting to see a bit of a crack up. And if you look at the Russell 2000 over in the US, it is now touching correction territory. It actually popped through it for a very small second last night, almost 10% contraction since their big high at the start of the year, and it does look like it will go that way. Tech stocks are already moving in that direction. You can see the breakdowns coming also in the NASDAQ, and that means the next one to watch is when it happens in the big area. So watching that S&P very, very closely. Yes, we touched an intraday, record all-time high on the intraday on Tuesday, but there is just no doubt that at the moment we're all watching what happens in those central banks, and it's going to be the word inflation that's certainly the key word over the next 3 or 4 months, because there looks like inflation is slowing, not just in the US, but here in Australia. You look at Japan, and particularly over in Europe, it's all starting to come around that word and whether or not it is actually moving in the right direction.
Okay, so we're hearing from Janet Yellen, as I mentioned, in less than an hour. So are we anticipating, that she'll be making any sort of new comments surrounding inflation?
I think that's where she will start to sort of move towards. They're all about, keeping that Fed funds rate as low as they can for a fair amount of period. Now, she's certainly always talked about unemployment. We know that their unemployment level is something she concentrates on very, very strongly. We did get a bit of a hollow unemployment number last round. We got it at 6.3% and 288,000 jobs added if you look at the non-farm payrolls. But again, it's the inflation side of it that you can see. Wage growth is 0 at the moment over in the US. It's the same here in Australia. You can also look to Europe as well. Wages at the moment are just not moving, and that is an indication of inflation. I think she's going to start shifting that way, that inflation in the US isn't moving as hard as she wants it to be. Therefore, they're going to have to remain in an accommodative stance for a longer period of time. And again, it's all about that Fed funds rate, and that's the quandary around bonds at the moment, is that there's no doubt that people are now buying into this idea that the rates are going to remain low. Yields, therefore, can go back down to the rates they were last year, because we're not going to see an increase there. So that's what I'm watching out of her, is her inflation talk and her inflation outlook, and whether or not her 2% target is going to be seen anytime soon.
Because I guess the key is, if you don't see that growth in wages, then, any sort of rise that we saw through the overnight period in that inflation report when it comes to food and petrol, gasoline, really, is negligible.
That's right, and I think that's the interesting thing out of all of this. Yes, we are starting to see employment pickups, but wage growth isn't there, and that therefore goes back to those leading indicators that have certainly seen all this movement. Consumer sentiment, which therefore feeds into consumer spending, may just start to wane, because people aren't actually seeing their real wages moving in the right direction, and that's not just a US phenomenon, it is happening globally, and that's the interesting thing at the moment, and why I think you're now starting to see the equity markets worried about earnings in the future. We got an okay US earnings season, a very okay earnings season here in Australia, but future earnings do look a little bit strained. China is slowing down. We've heard, the political parties over there talking about all of that idea that maybe things are a new norm, and new norms mean that maybe a slower economy is what we're going to experience, and all that feeds into it. So there is that cautiousness around a bit, and as I said, volatility is creeping up, bonds are on the way up, and equities on the way down. That just suggests that we may be due for a little bit of a pullback, and I think we're going to see that today.
Okay, so local market, obviously the SPY futures pointing to a pullback. I guess the whole metals picture and the metals complex, commodities complex is playing into what we can expect for the local market as well, with nickel, gold really being the focal points.
Yeah, certainly is indeed. And again, iron ore is holding ever so, slightly above that 100 US a tonne. So all that feeds into it. Nickel's been an interesting one, after that massive rally and that strength because of what's going on in Indonesia, also over in China, and that really drove it, but it's broken down very, very fast and very quickly. So another dramatic fall. It's now down 10.1% in 3 days. So watching that very closely, watching something like Western areas that may actually find that, swinning out. Gold also is testing levels as well, and also seeing a little bit of weakness, which is interesting as well. I think the other thing to be interesting and be aware of was the banks, and there was an okay recovery in Westpac, but it didn't eventuate in ANZ and NAB now that they've both got, all three have gone ex-dividend. So that may just provide a little bit of support because of that dividend pickup, but I agree, it's the material space that will see the pressure first, and then it will feed through into the rest of the market. The defensive are the only bright spots that I can see at the moment that may actually hold the line. Don't expect them to gain, but will hold the line. Maybe not as hard a fall as we saw on the Dow and the S&P last night.
No economic data here or in China, but we do get Japan industrial production. Now that's coming in the wake of the GDP read that we got yesterday. So is that likely to provide a little bit of direction for Asian markets through the afternoon?
Partly. Again, the GDP number yesterday was amazing if you want to look at it from the perspective that it was really, really strong, but that's also not surprising. The BOJ and also the central government predicted that would happen. It was very strong at 5.9% for the first quarter, but it's front-loading because obviously the consumption tax was coming, and the expectation was that consumer demand and consumer spending really drove up, and it did, if you have a look through it. So I think that will filter out, and the other issue of it is that a strong economy will probably see a pickup in the yen, and that is detrimental to the Nikkei. And that inverse correlation is around about 74%, and the strongest inverse currency to equity correlation you'll see in the world. And so if we do get a strong industrial production report, it will put the yen up, and that'll put the Nikkei backwards. So that's the conundrum that comes around that sort of play at the moment, is that the Nikkei needs a weaker yen. It needs what is an export nation to really see demand from China, demand from Southeast Asia and Europe to be driving their export economy to come back into the players like their communications, like their electronics, like their car manufacturers, that at the moment still haven't seen a pickup. It's coming, but it just hasn't seen that sort of drive yet. And that's what I'm watching, is that if industrial production is up, that is a good thing, but it will mean the yen goes up, and you'll probably see the Nikkei come off.
Okay, lots to think about, lots to digest. Looks like it'll be a tough day. Evan, thanks so much for joining us.
Thanks, Nadine.